5 seconds to the open.
Ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to you all around the world. Welcome to this new episode of the Follow the Money podcast. Today, episode number 508. We've entitled, You've Built the Wealth, Now What? Now what? What happens after you build wealth? I mean, really, not in theory, not what the books tell you, but actually in real life. You know, many people spend years, even decades, just focused on that one thing in their financial lives, and that is building, right? You're working, you're saving, you're investing, you're trying to do all the right things, you're being consistent, you're staying disciplined, and if you stick with it long enough, you start to see some progress and your accounts begin to grow, and at some point, you look up after you put your nose to the grindstone and you realize, I've actually built something here, and that's a great place to be. Many of our members have had their nose to the grindstone for years, and they've been working hard and saving and investing. You know, there's an old saying that says, more money, more problems, right? So while having a good amount of money is not necessarily a problem, what to actually do with it is where a lot of people kind of get uncertain. And that's because building wealth and then living off of the wealth are not the same thing. And nobody really talks about this. Nobody really walks you through that shift when you get there. So what often happens is that most people just keep doing what they've always done, right? They just keep using the same strategy and they have the same mindset. They kind of adopt the same approach. And sometimes that works out great. I can think of a few people that have just stayed in that mode and they've done wonderful. But there's a lot of people I've met over the years where they stumble right here, right? They have worked hard, they saved money, they've invested, and then when it comes time to rely upon that money, they get stuck. They're not really sure what's the right way. They don't necessarily optimize their distributions. They don't really know what's the most efficient way to proceed. And sometimes they take on extreme risk, just like, you know, they were 20 years younger, and that can really blow up sometimes. I've seen that happen. So as you get closer to needing the money that you have worked on, you know, building for so long, that's really important that we know what to do. And that's what we're going to talk about today. You see, the strategy that got you where you are may not be the one that gets you to where you actually want to go next. And so today in segment 1, we're going to focus on that. What to do once you are reaching that place where you transition from growth mode, building wealth mode, to actually beginning to live off of that wealth. How do we think about that? We're going to tackle that in segment 1. Segment 2, I'm going to get into the markets. We've had a lot of things going on in the markets lately, and I'll share my latest insights with you. So we got a great show today lined up. Let's get right into it. All right, so let's talk through this because this is something I see all the time. You have people who spend years, decades really doing the right things financially, right? They work hard, they save for a rainy day, they invest, those investments grow and they stay disciplined. And if they stick with it long enough, they end up with a nice pot of money that they can use in retirement. Maybe a few $100,000, maybe more, maybe a couple of million, you know, maybe even more than that. But either way, they've likely built a solid portfolio of assets that they'll be able to draw on in retirement. And at that point, that you want to begin tapping those assets that you've been building and building for all of your working years, many people forget that they need to begin shifting from maybe like an aggressive wealth building mode into a wealth preservation mode, right? You've got to get into the concept or the idea of no longer making contributions, but actually beginning to take distributions. And at this point, you're not really willing to take all the same excessive risks with your assets that you did during those working years, right? You're starting to think about how those assets and those accounts are going to support you in your non-working years. Maybe not today, but certainly soon enough. And that's a completely different problem because, as I mentioned, building wealth and living off of that wealth, they're not the same thing. They require different mindsets. When you're building, time is on your side, right? If the market drops, You view it as an opportunity and you keep investing. It doesn't really spook you. But when you are in that stage of life where you're beginning to take the money out, then timing becomes pretty darn important. A lot more than people realize, because if things go sideways in the market early on in those distribution years, as you start to take money out of your accounts, that can have a devastating impact upon your balance. And that can be very stressful, right? Very, very stressful. In fact, it reminds me of a discussion I was having not too long ago with someone about the famous 4% withdrawal rule in retirement, and how for so many years that was advocated as, the ultimate solution. Just take 4% out of your investments, out of your 401k, IRA, whatever. Just take 4% of the balance every single year, and then, you'll end up, not cannibalizing your assets by the time you die. And the truth is, if you drill down into that 4% rule, it really only works in a lab, right? I mean, it assumes no fees, no taxes, no trading costs, perfect rebalancing. And so really that rule kind of overstates, the success of that strategy. It doesn't really work historically. It's failed in real life, especially 1960s retirees. I was looking at a study not too long ago that showed that many retirees using the real mutual fund returns at 4% rule just ended up running out of money in 20, 25 years. Worst case scenario I saw was an individual who began to retire, actually retired in 1966 and began taking withdrawals. And they were broke by the late 1980s just using the 4% rule. And, when you factor in fees, it can even be worse than that, right? But the real killer here is that sequence of returns risk, right? Where the failure of your strategy in retirement, as you begin to take money out, if you have a combination of low returns and high inflation, and both of them occur early in retirement, that can really, really harm your overall balance and make it very stressful for you. And ultimately, what really kind of messes things up is we think in terms of like fixed withdrawals. Like, I'm going to take 4% out of my account, every year. Come hell or high water kind of concept. This is the 4% rule. And these fixed withdrawals are really the things that can really hurt you. So one of the things that we teach here, and we're going to be doing a lot more on this year and into next year, we're going to be laying out a really cool dynamic withdrawal strategy, right? Instead of that fixed 4%, you can actually use flexible withdrawals that are based upon market conditions, where you're minimizing withdrawals in bad years, increasing in strong years, and developing guardrails around your distribution strategy. We also have taught on this podcast and, of course, on our website about the 3-bucket system as well, where you have liquidity bucket, a safe growth bucket, and then a risk growth bucket. And when you have money spread out that way, it prevents you from having to, force selling in downturns. And it also cuts that sequence of returns risk. And probably most importantly, it just adds to your overall mental stability, right? It doesn't make you as stressed out. But the thing is that once you reach retirement and you've been building these assets, you're going to need income now. You still have bills, you still got life happening. You may not be working anymore, but you're still going to have to take money out. And if you're taking money out of something that is going down in value, that can really stress you out, right? And that's where people really begin to feel it. They don't always feel it right away, but especially over time. And here's the whole point of this first segment that I really want to get across to you, is that from my experience, it's very clear that many people don't actually have a plan for that phase of life, right? They got the investments, they got the various retirement accounts, they got the bank statements, they have maybe a little bit of real estate, whatever they have going on in their plan. But if you ask them, what's the smartest and most efficient way to optimize the income from all of these assets and accounts, they're not going to usually be able to answer, because it's a very tedious process to think about if you don't plan it early, right? It's not because they did something wrong. They did a lot of things right, but nobody ever sat down and walked them through that part, right? Maybe they took time to learn how to build their assets and grow the wealth, But now, how do you keep it? And then when you take money out of it, how do you take money out of it in a way that's optimized for the future? You could do it one way. You could take money from this asset and it could shave off 2 or 3 years of potential income for you versus taking it from this asset, right? How do you decide? How do you figure it out? And so what do they do in that case? Well, just like everything else in life, many times they'll just figure it out as they go, kind of wing it. They pull from this account this year, maybe another account the next year, adjust here a little, adjust there a little. And when the market is cooperating, it all seems fine. But when it's not, again, that's where that anxiety in retirement can really pop up. Not saying the market's the problem. It's really not. It's a critical piece of the whole thing. The market's just not designed to do everything. And see, that's where people get in trouble. They expect the same pool of money to grow and protect and produce income all at the same time. That's asking a lot from the market. What I've found over the years is this, that things get a lot clearer when you start realizing that every dollar that you have should have a job. You stop thinking in terms of accounts and you start thinking in terms of what role does these dollars have? Every dollar you have has a specific job. It's our job to ask ourselves what this money is actually supposed to do, right? Is it there for stability? Is it there for growth? Is it there to produce income? Because these are all very different jobs. And when those roles aren't clear, then everything kind of just bleeds together. You end up pulling from growth assets when you shouldn't. You end up taking risks in places that you don't need to. And all those decisions can get a lot harder than they really need to be. Of course, not everybody's in the same spot. I mean, some people are still building, they need growth, they've got time. Other people, they've already built something and their situation is different. And for these folks, I believe it all boils down to how they structure their assets so that they can get that optimal income from those assets in their non-working years. And that's really the problem that I've seen, is that it's not usually a problem that they need more money or that they need better returns. Really, they just need their plan to be optimized and structured just a little differently. So here's my one big idea to leave with you here in segment 1. And that is, if your entire plan depends upon the market behaving well, upon the market cooperating, especially as you get closer to needing retirement income, then that is something that you definitely want to take a closer look at. No need to panic, no need to overreact, just understand it clearly. Because once you begin to see it clearly, you can actually do something about it. I'll have more to say on this topic in some future podcast episodes. So if this is a topic that interests you, be sure to stick around. We're going to be talking more about some really cool withdrawal strategies once you get to retirement, how to actually begin to take that money out in the most efficient and optimal way so that you don't run out of money in your golden years. All right, friends. Well, let's take a quick break. And when we come back, I'll walk you through what I'm seeing in the market right now and share with you my latest insights. Hold tight. Hey friends, Jerry Robinson here from followthemoney.com. Before we continue with today's podcast, let me just mention something really quickly. If you've been listening to the podcast for a while and you're starting to think more seriously about your own situation, your investments, your retirement plan, and how everything is actually structured, there comes a point where it helps to talk it through with someone. And that's why we created our Follow the Money Advisor Referral Service. We work with a network of trusted financial professionals across the country, and we can connect you with someone who can help you take the next step, whatever that looks like for you. Maybe it's reviewing your current retirement plan, or maybe it's putting a real income strategy in place, or maybe you just have a simple question like getting a life insurance quote. If that sounds helpful, you can learn more at followthemoney.com/advice, or just give us a call at 800-609-5530. No pressure, just a chance to get some clarity around where you are and where you're going.
Welcome back to Follow the Money Weekly. And here's Jerry Robinson.
All right, friends, welcome back to one of the longest running personal finance podcasts on earth. You're listening to the Follow the Money podcast. My name is Jerry Robinson. Let's take a look at what's been going on in the markets lately. And as always, we're not trying to predict anything. We're just watching how things are behaving. You know, price tends to tell you what matters, not the headlines, not the numerous opinions on social media. So let's just take a look at what's actually happening. What is the price action suggesting? Well, first of all, you got to really stand in awe of what we have seen in terms of the stock market over the last couple of weeks. The last time we were here together, remember the market had really been sold off, and we saw that big tech stocks were down pretty hard. The NASDAQ 100 was down. We had talked about that on one of our latest podcasts, really quite something. But we have seen this incredible V-shaped recovery in the S&P 500. It's even gone beyond its former high. So now the S&P sitting near a fresh record high above 7,100. We got down into what we call the demand zone on the S&P 500, which is really between 6,150 and 6,500. And the market reacted in that area and blasted higher. So now we're back above 7,000. We got great 200-day moving average support on the S&P 500. And so far, so good. Here we are in earnings. The earnings season is back in play. And this week, by the way, one of the biggest weeks of the whole earnings season. You've got Apple reporting. You've got Amazon. You've got Alphabet. You've got Meta. You've got Microsoft. You got some, many of these major big tech companies or Mag 7 companies that are reporting this week. So we could see some outsized volatility. We've also seen the NASDAQ 100. QQQ is the ETF we like to track it with, also having this very sharp recovery. That ETF was trading at about 555 or so towards its lows in early April. And now we're at about 660, right? So we've had a very impressive rally in the NASDAQ 100 over the last few weeks. The volume has been not as large as what we have seen earlier in the year. I don't think that's a warning sign. I think that it's just kind of part and parcel of what's going on here. I don't think that there's any concerns there. If you look at a weekly chart, by the way, of the NASDAQ 100, it really is interesting. It came down to its 50 weekly moving average, which is a really important trend indicator. And it bounced right off of that 50 weekly after encountering it for a few days, and really had a really nice rally off of that area. So the NASDAQ 100 continues to look good, sitting near fresh record highs. We've also seen some general weakness appear in gold and silver. Let me talk about gold first. So gold, of course, having a really wild trade throughout 2026. It looks like a roller coaster when you think about 2026. The year started with gold, around 4,400 or so, 4,300. We got as high as 5,600 at one point, right? Then we fell all the way to 4,100. So, I mean, this thing's been trading like a meme stock in 2026. Really wild price swings. Well, anyway, right now we're sitting in an interesting place on gold. We are in what we call a demand zone here, which we are looking at somewhere between 4,400 and 4,650, somewhere in that range. That's where we're seeing quite a bit of demand. That's where we're sitting right now in terms of price. But we're also sitting between a rising 200-day moving average, that's bullish, and a declining 50-day moving average on the daily chart. That's, not terribly bearish, but nonetheless, it will serve as overhead resistance. We've had a hard time getting past that 50-day moving average. What we really want to see is a breakout above that level, which is about 4,850, but then also the really key psychological resistance at 5,000, that big round number. That's pretty big resistance. Gold, we think, is still very well set up for the future as far as the next several months, but also into the end of the year and into next year. I'm not of the opinion that the upside in gold has passed, that somehow the uptrend is over. The uptrend is still clearly intact. There's a lot of key levels that would have to be violated for gold to no longer be in an uptrend. But we have had several days of selling pressure here in gold, falling from around 4,850 or earlier this month down to about 4,500, which is where we are now, 4,550 or so. So that's what we're looking at with gold. Again, not too terribly concerned, just a ton of overhead resistance there because we had that huge rally, and then we're trading below it. So that serves as that overhead resistance. Now, let's also talk about the U.S. dollar, which is beginning to firm up a little bit. It's still sitting below that 100 to 101 level, the U.S. dollar index. That's a key area of resistance. We haven't seen it break past that all year long. In fact, we haven't been above that level. You got to go back to this same time last year. So the dollar has been under big pressure. And then we also have the Federal Reserve meeting. That's going to be today. Just a little, they're actually doing it today. They're going to release their latest statement later today. And now that Jerome Powell is no longer under any kind of criminal probe from the DOJ, that's taken that pressure off. It looks like Kevin Warsh, who testified before the Senate, is going to be the new incoming Fed chair. We'll see if he gets approved. Tom Tillis, the senator who was saying that he was not going to approve Warsh until all of the pending criminal probe around Jerome Powell had come to an end. Well, apparently the DOJ has dropped that probe. And so now that means that Tillis has signaled that, Senator Tillis says he will greenlight Warsh. So it looks like Warsh, unless there's something else, and there's a lot of weird question marks around Kevin Warsh, by the way, his wealth, some of the different things that he is invested in. There's a lot of questions. A very, very rich guy. I mean, the guy's sitting on, hundreds of millions of dollars. So he's very wealthy. There are some concerns. But I watched his testimony the other day, and I'm gathering from him that, we're going to see some rate cuts this year. And if you look at the Federal Reserve, what they call the Fed Fund futures market, if you look at that, you'll see that there is absolutely zero expectations of any rate cuts this year, right? It's just the probabilities are 80% or higher that we will not see any kind of rate cut this year. And I think that's misguided. Not because I think that we need rate cuts, don't get me wrong, but I think the president of the United States has made it pretty clear he wants rate cuts, right? And Mr. Warsh has already stated that, he sees that we may need rate cuts. He's talking about these long and variable lags from the Federal Reserve and how if we don't cut now, we got to wait 12, 15 months or whatever for it to actually work its way into the system. He's also, talking about the deflationary pressures from AI and so how that could counteract inflation and all of this. We still haven't seen the whole fallout from the surge in oil prices also and how that's going to trickle down into the inflationary numbers, the figures that come out of Washington. So it's a big question mark. But anyway, the Fed is meeting today. They're going to release their statement today. We expect no rate cut today whatsoever. But we might get a little bit of guidance on what the global oil situation is doing to the U.S. economy. Maybe we'll get some information there. Okay, let me also talk about the price of silver, which also has been under a little bit of pressure as of late. It's trading at about $72 as I speak. Now that's well off of its highs of 120 earlier this year, right? So it's really come down sharply. Now there's a key number that I always talk about on silver when I look at the daily chart, and that's that 30 simple moving average. If you take a chart of silver and just apply a 30 SMA to it, 30 simple moving average, look at that line and you'll see exactly what I mean. It acts very interesting around that area. It's a kind of a sticky number, a sticky figure, sticky metric for silver. Right now it's struggling around that line. It just recently slipped below it this week after going back above it earlier this month. So it's been struggling around that area. Let's see what happens. But the 30 is falling. The 200-day is rising. And so silver, we believe, is not done with its uptrend. The uptrend's still intact. We just saw some data come out from the Bank of America Metals desk. Their research team over at Bank of America saying they expect to see silver back in the triple digits by the end of the year. Their analysts saying somewhere between $135 and $300. Well, we'll see about that, right? We've heard a lot of statements about these high silver prices. They've yet to translate in the near term, but 120, that's where we hit recently. That's pretty impressive. Could we get back there? Oh, certainly. I think the structural and fundamental things that underline the silver trade make it clear that we're very likely to see more upside ahead. You got to be patient. It doesn't just automatically happen. Oil prices, by the way, really on the move. We have crude oil, like here in the United States, West Texas Intermediate, trading at about $107 right now. I mean, you got to remember, it was around 80 earlier this month, right? So that's really gone up. Brent crude really on fire, up to nearly $120 as I record this. That would be around the highest level we've seen since the U.S. war against Iran, the U.S.-Israeli war, I should say, against Iran broke out. So, Brent crude at a big high. We just had the UAE announced that it's leaving OPEC, right? They've been in OPEC for, decades, and now they're just leaving. Gasoline prices are at a fresh high for the year. We haven't seen gas prices this high since 2022. Heating oil's back on the rise. Natural gas still very depressed, though. But overall, the whole energy complex here in a really interesting place. And there may be a lot more to come in terms of interesting stuff, regarding the energy space in the days ahead. So we're watching all of that. Finally, let me just check in real briefly on Bitcoin and ETH. Bitcoin, well off of its February lows when it got down near 60,000. I've told our members here, I've been a long time investor in Bitcoin and ETH. And so I tend to watch those levels a lot. And the level that I had expected for, as far as a support area this year could be in the $50,000 to $60,000 range. It wouldn't surprise me if we got to 50,000 on Bitcoin. It seems like we've rejected those lows. We came down to about 60. We really haven't hit that low since. Right now we're trading at about 75, 76,000. We're still trading below a declining 200-day moving average, which is going to be big, hefty resistance overhead. So the other key area I'm watching on Bitcoin is the 200 weekly moving average, which is right around that 60,000 level. But again, I could see us going down to 50,000 if the selling restarts. And then also ETH, which has struggled also along with Bitcoin a bit more this year. In fact, ETH has really been leading to the downside out of the two, suffering more than Bitcoin in terms of sheer downside return this year. But we also touched a low on Ether at 1750 back in February, and we have held up pretty well. Now, there's a big resistance overhead here around 2450 or so, and we're struggling below that. We're about 2275 or so as I speak. So there's plenty of overhead resistance ahead. There's that declining 200-day moving average right around the 2750 area. So again, these cryptos facing some, still kind of in a funk, kind of in a winter, which we think will likely resolve and will probably begin to move out of the woods by the end of the year, especially as we get into the fall, right around election time. So there's a quick wrap of the markets. We're always looking at the markets and always paying attention to what's happening in the economy. We provide a lot of that information to our members here at followthemoney.com. We just did a big webcast for our members on Tuesday. Every Tuesday morning, we do a live webcast. Members can ask questions. We go over charts. We go over what's happening in the economy, tackle the Fed and, all these different strategies that you can use trading or investing. So if you're into that, you need to get on the other side, right? Come join us on the other side. Just go to followthemoney.com/join and pick out a plan that's right for you. We'd love to see you here. And we'll be right back with our concluding thoughts and a final word. Hold tight. All right, friends, welcome back to the final moments of today's broadcast. And if you think about everything we talked about today, it really comes down to a pretty simple idea that most people just spend a long time learning how to build wealth. They get good at it, they stay disciplined and make progress, and if they stick with it, they end up with something meaningful. But at some point, the question changes from how do I grow this money to how do I actually make this money work for me? And this is where things can get a little unclear. Again, not because you've made bad decisions, but because nobody really walks you through how to take wealth that you've created or built and then turn it into an income that's optimized and efficient, right? Instead, they just keep doing what they've been doing. The same approach, the same mindset. And sometimes that works out fine, but sometimes it creates a lot of financial pressure that really doesn't need to be there, especially when you start relying on that money in retirement. When we're younger, we think in terms of growth, but when we get older, it becomes more about how that income is going to show up and how much of your plan depends upon the market, which may or may not be willing to cooperate, right? And so if there was just one thing I would encourage you to do, it's this. I would encourage you to take a step back and ask yourself, if I had to rely upon the money that I've built up in my accounts and my retirement accounts and all of this, my pension, would I understand how to do it? Right? Would I be able to optimize it? Would I be able to actually turn this cash into cash flow? Not in theory, not based upon some unrealistic rule, but actually in real life. You know, there's a quote that I've come back to quite a bit over the years, and it goes something like this. Just an old adage. Most people spend a lifetime building wealth and almost no time learning how to use it. That's just something to think about, isn't it? And if this is something that you've been thinking about, if you're starting to look at your situation and you want a little more clarity around how it all fits together, that's exactly why we've set up our Follow the Money advisor referral service. We set this up back in 2010. We've had it going for 16 years now, where we work with a network of trusted financial professionals around the country, and we can help connect you with someone who can walk through your situation with you. Nothing formal, no upfront costs, no pressure. Maybe you need a full plan. Maybe you just need a second opinion. Maybe it's just something simple that you've been meaning to look into. But if any of that sounds helpful, you can learn more at our website, followthemoney.com/advice, or you can call us directly, 800-609-5530. All right, friends. Well, that brings us to the end of today's broadcast. It's been an absolute honor and joy to be with you. And remember, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and we'll see you right back here next time. Until then, God bless.
Contained on the Follow the Money podcast is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decisions.